going to make you rich overnight, but if you apply them consistently, if you commit to them for decades, they will build wealth, real, substantial, generational wealth. And that's what I want to share with you today. 5 wealth lessons, not from theory, not from textbooks, but from real experience. From building a company from 8 people in a room to $11 trillion in assets. From working with the world's richest investors and seeing what actually works. These are the lessons that separate people who build lasting wealth from people who chase money and never catch it. These are the principles that have guided my entire career, and they can guide yours too. Let's get into it. All right, first lesson, and this is the most fundamental wealth building principle I know. Ownership compounds, income doesn't. Let me explain what I mean. When I was young, fresh out of UCLA with my MBA, I joined First Boston. I had a good salary, I was making decent money, and I thought that's how you build wealth. You get a good job, you earn a high salary, you save what you can, and eventually you have some money put away. But that's not how real wealth is built. That's how you stay comfortable, maybe even upper middle class comfortable. But you don't become wealthy through salary. You become wealthy through ownership. Here's the difference. Income is linear. You work, you get paid. You work more, you get paid more. But there's a ceiling. There are only so many hours in a day, only so much you can charge for your time. And when you stop working, the income stops. Ownership is exponential. When you own assets, when you own pieces of businesses, when you own real estate, when you own investments that grow in value, your wealth compounds. It grows while you sleep. It grows while you're on vacation. It grows without you having to trade your time for money. And here's the critical insight. The richest people I work with, the people who've built fortunes of hundreds of millions, billions of dollars, they all understand this. They don't think about income. They think about ownership. Let me give you my own example. When we founded BlackRock in 1988, I took a pay cut. I was making good money at First Boston, but I took less salary to have equity in this new company. My colleagues thought I was crazy. Why would you give up a sure paycheck for uncertain equity in a startup? But I understood something they didn't. I understood that owning a piece of a growing business, even a small piece, was more valuable than any salary. And I was right. As BlackRock grew, as we went from managing a few $1 billion to hundreds of billions to trillions, my ownership stake became extraordinarily valuable. Today, my net worth is estimated at $1.3 billion. And that wealth didn't come from salary. Even though I've been CEO of one of the world's largest companies for decades, it came from ownership, from owning BlackRock stock, from that equity compounding as the company grew. Now, let me make this practical for you. You might be thinking, Larry, I'm not starting a company. I'm not going to be CEO of BlackRock. How does this apply to me? And here's the answer. You need to own assets. Whatever assets you can afford, stocks, real estate, index funds, ETFs, pieces of businesses, anything that has the potential to grow in value over time. I've been very public about this. I recommend that investors put at least 80% of their total discretionary assets into equity investments or hard assets. At least 80%. And for investors who have sufficient risk appetite and a long time horizon, I've said they could invest 100% in equities. Why? Because over long periods, 20, 30, 40 years, equities dramatically outperform cash and bonds. It's not even close. Since 1926, U.S. stocks have returned about 10% annually. Bonds about 5%, cash about 3%. That might not sound like a huge difference, but it compounds into enormous wealth gaps. $100,000 invested in stocks in 1926 would be worth over $600 million today. The same in bonds? Maybe $7 million. In cash, less than $1 million. That's the power of ownership. That's the power of assets that compound. And here's what's changing, what I'm really excited about. We're democratizing ownership. For 400 years, Since the Amsterdam Stock Exchange opened in 1602, capital markets have been expanding access. First, it was wealthy merchants, then middle-class artisans and shopkeepers. Today, about 60% of Americans own stocks. But there's still a divide. There are still assets that only the wealthiest have access to: private equity, infrastructure, private credit, real assets. These have historically been locked behind high walls, available only to institutions and ultra-high net worth individuals. And guess what? Those assets have outperformed public markets. Pension funds, which invest in both public and private assets, have outperformed 401k plans, which are mostly limited to public stocks and bonds, by about 0.5% per year. That might sound small, but over 40 years, that 0.5% compounds to 14.5% more wealth, enough to fund 9 more years of retirement. So at BlackRock, we're working to change this. We're building products that will give everyday investors access to private markets, to infrastructure, to private credit, to the same assets that pension funds and sovereign wealth funds invest in, because I believe this fundamentally capitalism did work just for too few people. The solution isn't to abandon markets, it's to expand them, to let more people own a meaningful stake in the growth happening around them. So here's lesson number 1. Think like an owner, not an earner. Build your portfolio around assets that compound. Stock, real estate, private investments when you can access them. And over decades, let that ownership compound into real wealth. Ownership compounds. Income doesn't. That's the first lesson. All right. Lesson number 2. And this one separates amateur investors from professionals, from the truly wealthy. Your time horizon is your competitive advantage. Let me explain. Most investors think the advantage in markets comes from information, from knowing something others don't, from being smarter, from having better analysis. And yes, those things help, but they're not the real edge. The real edge, the sustainable competitive advantage that individual investors can have, is time horizon. The ability to think and invest for decades, not months or years. And most people, most institutions even, can't do this. Why? Because they're measured on short-term performance. Hedge funds are judged quarterly. Mutual fund managers are judged annually. If they underperform for a couple of years, investors pull money, they get fired. So they're forced to think short-term. They're forced to chase performance. They're forced to do things that look good in the short run, even if they're suboptimal in the long run. But individual investors, you don't have that constraint. Nobody's firing you for underperforming in a single year. You can take a truly long-term view, and that's incredibly powerful. Let me give you some examples from the richest investors I know. Warren Buffett, probably the most successful investor of all time. What's his secret? It's not that he's smarter than everyone else. It's that he thinks longer term than everyone else. He buys companies expecting to hold them forever. Not 5 years, not 10 years, forever. And because he has that time horizon, he can ignore short-term volatility. He can buy during panics when everyone else is selling. He can hold through recessions when everyone else is panicking. And over decades, that patience compounds into extraordinary returns. Same with the best family offices I work with. These are families that have been wealthy for generations. And you know what they all have in common? Long time horizons. They're not trying to get rich quick. They're trying to stay rich for 100 years, for multiple generations. So they make decisions differently. They don't chase the hot stock. They don't try to time the market. They build portfolios designed to compound over decades. And they have the discipline to stick with those portfolios through bull markets and bear markets, through booms and busts. Now, let me tell you why this matters for you. Having a long time horizon changes everything about how you invest. First, it allows you to take intelligent risks. If you're investing money you need next year, you can't put it in stocks. Too risky, too volatile. But if you're investing money you won't need for 20 or 30 years, you can and should be heavily in stocks. Because over 20-year periods, stocks have never lost money historically. Never. That volatility that feels risky in the short term becomes irrelevant in the long term. Second, it allows you to ignore market timing. When you have a 30-year time horizon, trying to time whether to buy today or wait 3 months, it doesn't matter. You're going to own this asset for 3 decades. Whether you bought it in January or June is going to be noise. So you can just buy systematically, consistently, without stressing about timing. Third, it lets you take advantage of compounding. Einstein supposedly called compound interest the 8th wonder of the world. And he was right. But compounding only works if you give it time. 10% annual returns double your money in about 7 years. That's nice. But in 20 years, you've got 7 times your money. In 30 years, 17 times. In 40 years, 45 times. That's the power of time. That's why time horizon is your competitive advantage. At BlackRock, we think about this constantly. When we're managing money for a 30-year-old saving for retirement, we're thinking about a 40 or 50-year time horizon. That completely changes our strategy compared to managing money for someone who needs income in 5 years. And this is where I get frustrated with how most people invest. They treat their retirement accounts like trading accounts. They check them constantly. They react to news. They move money around based on what happened last month. And all of that is destroying their long-term returns. If you have a long time horizon, use it. Build a portfolio appropriate for that time horizon, heavily weighted toward equities and growth assets, and then don't touch it. Don't check it every day. Don't react to market movements. Just let it compound. I've said this publicly many times. For a long-term investor with a long-term view who can tolerate market volatility, you should be at least 80% in equities or hard assets. That's my recommendation. And it's based on this fundamental principle: time horizon is your advantage. So here's lesson number 2. Think in decades, not days. Use your time horizon as your competitive edge. Build a portfolio for the long term and have the discipline to stick with it through all the short-term noise. Time horizon is your competitive advantage. That's the second lesson. All right, lesson number 3. And this one is deeply personal for me because I learned it the hard way. Risk management is wealth preservation. You can't build lasting wealth without managing risk. Let me tell you a story. In 1986, I was at First Boston running the mortgage-backed securities desk. We were doing well, making money. I was getting promoted. Everything looked great. And then we had a massive loss, like massive, the kind that could have brought down the entire firm. What happened? We thought we understood the risks. We thought we had it managed, but we didn't. We were exposed to interest rate risk in ways we didn't fully comprehend. And when rates moved against us, we got crushed. That experience, as painful as it was, taught me the most valuable lesson of my career. You can make all the right investment decisions, but if you don't manage risk properly, one bad event can wipe you out. And when I started BlackRock in 1988, risk management became our foundation. We built Aladdin, a risk management platform that's now used by institutions managing over $30 trillion globally. We made risk transparency and risk management our core competency. And that's a huge reason why BlackRock survived and thrived through multiple crises when others didn't. Now, let me tell you what risk management actually means, because most people misunderstand this. They think risk management means avoiding risk, playing it safe, staying in cash and bonds, and that's wrong. That's not risk management. That's risk avoidance. And risk avoidance is its own kind of risk because you miss all the growth. Real risk management is about understanding your risks, sizing them appropriately, and ensuring that no single event can destroy you. It's about positioning your portfolio so you can survive the worst case scenarios while still capturing upside in the good scenarios. Let me give you specific examples of what this looks like. First, diversification. This is the most basic form of risk management. Don't put all your money in one stock. Don't put all your money in one sector. Don't put all your money in one country. Spread your risk across different assets, different geographies, different time horizons. I recommend what we call the 50-30-20 portfolio. 50% stocks, 30% bonds, 20% private and alternative assets. This isn't just random numbers. It's a risk-managed allocation that gives you growth from stocks, stability from bonds, and diversification from alternatives. Second, liquidity management. Always have cash available. I don't care how high your net worth is. If everything's tied up in illiquid investments, if you can't access money when you need it, you're vulnerable. You might be forced to sell assets at the worst possible time just to meet expenses or obligations. The richest investors I know always maintain liquidity, maybe 5, 10, 15% in cash or near cash. It's insurance, it's optionality, it's the ability to act when opportunities arise or when emergencies happen. Third, leverage management. This is critical. Borrowed money amplifies gains, yes, but it also amplifies losses. And it can create situations where you're forced to sell at exactly the wrong time. I've seen brilliant investors destroyed by leverage, wiped out not because their thesis was wrong, but because they were over-leveraged and couldn't survive the volatility. My rule, only borrow against assets if the interest rate is low and fixed, and only if you're confident you can service the debt, even in the worst-case scenario. For most individual investors, that means being very conservative with leverage. Maybe use it for a mortgage on a primary residence, but don't use it for investment leverage. Too dangerous. Fourth, tail risk hedging. This is more advanced, but important. Tail risks are the low probability, high impact events. The 2008 financial crisis, the pandemic, 9/11. These things happen rarely, but when they do, they can be catastrophic. Rich investors hedge these risks. Maybe they hold some gold as insurance against currency collapse. Maybe they have some Bitcoin as a hedge against government dysfunction. Maybe they use options to protect against market crashes. The point is, they're thinking about and preparing for the worst case scenarios. At BlackRock, we model tail risk constantly. What happens to our portfolios if there's another financial crisis? What if there's a war? What if inflation spikes to 10%? We run these scenarios and make sure we're positioned to survive them. Fifth, and this is maybe most important, emotional risk management. The biggest risk to your wealth isn't market crashes, it's you. It's your emotions making you sell at the bottom or buy at the top. It's panic, it's greed, it's fear. So you need systems to manage your emotional risk. Written investment plans that you commit to following. Automatic rebalancing. Rules for when you buy and when you sell. Accountability partners who can talk you off the ledge when you want to do something stupid. The richest investors I know, they all have systems to prevent emotional mistakes because they know that's the real risk. Here's what I want you to understand. Risk management isn't about avoiding upside. It's about ensuring you survive long enough to capture the upside. It's about positioning your portfolio so that when the inevitable bad events happen, and they will happen, you don't get wiped out. You stay in the game. And by staying in the game, you give compounding time to work its magic. BlackRock has survived and thrived for 37 years, not because we avoided risk, but because we managed it better than anyone else. And that principle applies to individual wealth building too. So here's lesson number 3. Master risk management. Diversify intelligently, maintain liquidity, avoid dangerous leverage, hedge tail risks. And most importantly, build systems to manage your emotional risks. Risk management is wealth preservation. That's the third lesson. All right, lesson number 4. And this one goes against everything you'll hear in popular investing circles. Build what lasts, not what's hot. Let me explain. In every era, there are hot investments. Things everyone's talking about. Things that are going up fast and making people rich quickly. In the 1990s, it was dot-com stocks. In the 2000s, it was real estate and subprime mortgages. In recent years, it's been crypto, meme stocks, SPACs, NFTs, and the temptation is enormous. You see people getting rich quick. You see your neighbors making money. You feel like you're missing out, and you want in. But here's what I've learned from working with the richest, most successful investors in the world. They don't chase what's hot. They build what lasts. They invest in enduring value, not temporary trends. Warren Buffett never bought dot-com stocks at their peak. Everyone said he was out of touch, that he didn't understand the new economy. But he stuck to businesses. He understood businesses with real earnings, businesses that would last. And when the bubble burst, he was fine. Better than fine. He was positioned to buy great companies at discount prices. Same with the best family offices. They're not chasing the hot new thing. They're building diversified portfolios of lasting assets, real estate in good locations, shares of market-leading companies, infrastructure, businesses with competitive moats, things that will have value in 50 years, not just 5. Now, let me tell you why this matters. Building what lasts requires a completely different mindset from chasing what's hot. First, it requires focus on fundamentals, not narratives. When something's hot, there's always a great story. The internet is changing everything. Real estate never goes down. This cryptocurrency is the future of money. The story is compelling, exciting, but the fundamentals might be terrible. When you build what lasts, you focus on fundamentals. Does this business make money? Does it have a sustainable competitive advantage? Is management competent and honest? Will this asset generate cash flow in 10 years, 20 years, 30 years? These are boring questions, but they're the right questions, and they lead to boring answers. Buy the S&P 500, buy blue chip dividend stocks, buy investment grade bonds, buy real estate in growing markets. Not sexy, but lasting. Second, it requires patience. Hot investments move fast. They go up 50%, 100%, 500% in a year. It's exciting. It's addictive. But lasting wealth is built slowly. 10% a year, compounded over 40 years, beats 100% in 1 year, followed by crashes. The richest people I know, they're not trying to get rich quick. They're already rich. They're trying to stay rich and get richer steadily over decades. That requires patience, the discipline to not chase, the wisdom to let compounding do its work. Third, it requires focus on quality, not speculation. Hot investments are often speculative. They're betting on future growth that may or may not materialize. Lasting investments are based on current value creation, companies that are already profitable, real estate that's already generating rent, assets that produce cash flow today, not promises of cash flow tomorrow. At BlackRock, we've always prioritized quality. When we buy for our clients, we're looking for businesses with strong balance sheets, competitive advantages, consistent earnings, not speculative growth stories. And over decades, that focus on quality has dramatically outperformed speculation. Fourth, it requires long-term partnerships, not transactions. This is something I learned early. When we started BlackRock, we didn't chase every client. We didn't try to sell every product. We focused on building deep, long-term relationships with a smaller number of high-quality clients. And those relationships, built on trust and mutual benefit over decades, they became the foundation of our success. Clients stayed with us through good times and bad. They gave us more assets to manage. They referred other clients. That's how you build a lasting business. Same principle applies to personal investing. Don't just make transactions. Build relationships with quality companies by being a long-term shareholder. Build relationships with quality real estate by being a long-term owner. Build relationships with quality advisors by committing to work with them for decades. Fifth, it requires thinking about legacy. Hot investments are about you getting rich now. Lasting wealth is about building something that outlasts you. That can be passed to your children. That can fund your grandchildren's education. That can make a difference in the world. The family offices I work with, the ones that have been wealthy for generations, they think about legacy. They're not trying to spend all their money before they die. They're trying to build institutions that will last for 100 years. And that mindset, that focus on legacy, it changes everything about how you invest. You become much more conservative, much more focused on preservation, much more willing to accept lower returns in exchange for lower risk and greater certainty. At BlackRock, we think about this all the time. We're not just trying to have a good quarter or a good year. We're trying to build an institution that will last for generations. That will serve clients' grandchildren. That will be relevant in 2100. That long-term thinking, that focus on building what lasts, it's been core to our success. So here's lesson number 4. Don't chase what's hot. Build what lasts. Focus on fundamentals. Be patient. Prioritize quality. Build relationships. Think about legacy. The hot investment of today will be forgotten tomorrow. But lasting value compounds into generational wealth. Build what lasts, not what's hot. That's the 4th lesson. All right, final lesson. Lesson number 5. And this one is less discussed but incredibly important. Influence and reputation are assets. Real, valuable, wealth-building assets. Let me explain what I mean. When people think about building wealth, they think about financial assets. Stocks, bonds, real estate. And yes, those matter. But there's another category of assets that the richest people in the world understand and cultivate. Soft assets. Reputation, network, influence, expertise. These don't show up on a balance sheet, but they create enormous value. They open doors. They create opportunities. They allow you to invest in deals that others can't access. They give you information and insights that others don't have. Let me give you my own example. Today, when I speak, markets listen. My annual letters to CEOs are read by world leaders. When I'm concerned about something, it makes headlines. When I recommend something, it influences billions of dollars in capital flows. That's influence, that's reputation, and it's incredibly valuable, not just to my ego, though I'll admit it's gratifying, but to BlackRock's business, to our clients' portfolios, to the opportunities we can access. When BlackRock wants to make a strategic acquisition, we can get meetings with anyone. When we want to invest in private deals, we get called. When governments need advice on financial systems, they call us. Why? Because of the reputation and influence we built over decades. And here's the thing, you don't need to be managing $11 trillion to benefit from this principle. You just need to understand it and deliberately cultivate it. Let me tell you how. First, become an expert at something. The richest people I know, they're not generalists. They're specialists with deep expertise in specific domains. Maybe it's a particular industry. Maybe it's a type of investment. Maybe it's a geographic market. Whatever it is, they know more about that thing than almost anyone else. And that expertise becomes an asset. People come to them for advice. They get invited into deals. They're asked to join boards. They have access that others don't because of their specialized knowledge. So pick something. Study it deeply. Become the person others call when they have questions about that topic. That expertise will open doors. Second, build a valuable network. Not just any network, a valuable network. People who can help you. People you can help. People who create opportunities. The richest investors I know, they have incredible networks. They know CEOs, government officials, other wealthy investors, deal makers. And they nurture those relationships, not in a transactional way, but genuinely, they help when they can. They share information. They make introductions. And over time, those relationships compound, just like money compounds. A favor here, an introduction there, and suddenly you have access to opportunities that would never come to you otherwise. Third, build your reputation for integrity. This is non-negotiable. The richest people I know, the ones who've built lasting wealth across generations, they have impeccable reputations. Their word is their bond. They do what they say they'll do. They're known for being fair, honest, and reliable. And that reputation, it's worth more than money. Because once you lose it, you can't get it back. And with it, you can access anything. I've seen deals happen on a handshake because both parties had reputations for integrity. I've seen investors get into exclusive opportunities just because the deal sponsor knew they'd be good partners. Reputation matters. Fourth, share your knowledge. This might seem counterintuitive. Why would you give away your expertise? Won't that make you less valuable? Actually, the opposite is true. The more you share, the more valuable you become. My annual letters, they give away a lot of what I think about markets, about investing, about the economy, but they don't diminish my value. They enhance it. They establish me as a thought leader. They create trust. So whatever your expertise is, share it, write about it, speak about it, help others. And paradoxically, you'll become more valuable, more influential, more sought after. Fifth, play the long game with relationships. Every interaction is an opportunity to build or damage your reputation. Treat people well. Even when there's no immediate benefit, be generous. Even when you don't have to be. Because you're not playing for today, you're playing for decades. The richest people I know, they maintain relationships for 30, 40, 50 years. They do business with the same families across generations. They build trust that compounds over time. And that trust creates opportunities that no amount of money can buy. At BlackRock, we've built our reputation over 37 years. Every client interaction, every annual letter, every crisis we navigated, every promise we kept, all of it accumulates into a reputation for reliability, expertise, and integrity. And that reputation is arguably our most valuable asset. So here's lesson number 5. Treat influence and reputation as assets to be cultivated. Become an expert. Build a valuable network. Maintain impeccable integrity. Share your knowledge. Play the long game. These soft assets compound just like financial assets, and they create opportunities and access that money alone can't buy. Influence and reputation are assets. That's the 5th lesson. All right, let me bring all of this together for you. 5 wealth lessons from the richest investors. Lesson 1, ownership compounds, income doesn't. Build your wealth through owning assets, not just earning income. Lesson 2, time horizon is your competitive advantage. Think in decades. Use patience as your edge. Lesson 3, risk management is wealth preservation. Master the art of sizing and managing risk intelligently. Lesson 4, build what lasts, not what's hot. Focus on enduring value, not temporary trends. Lesson 5, influence and reputation are assets. Cultivate expertise, network, and integrity as deliberately as you build financial wealth. Here's what's powerful about these 5 lessons. They compound. They reinforce each other. When you combine them, when you apply all 5 consistently over decades, they create extraordinary wealth. You own assets. Those assets compound over time because of your long time horizon. You protect those assets through intelligent risk management. You focus on lasting value, not chasing trends. And your reputation and network give you access to better opportunities, which accelerates the whole cycle. That's how generational wealth is built. Not through luck, not through timing, but through consistent application of fundamental principles over long periods. Now, I want to address something. You might be thinking, Larry, these principles sound great, but you started with advantages I don't have. You got an MBA from UCLA, you worked at First Boston, you had connections. How do these lessons apply to someone starting from scratch? And here's my answer. I did have some advantages: education, early career opportunities, but I also came from a middle-class family. My dad owned a shoe store. I wasn't born wealthy. I built wealth by applying these exact principles. And more importantly, I've watched thousands of our clients build wealth from much more modest beginnings. I've seen immigrants come to America with nothing and build multi-million-dollar portfolios. I've seen teachers and firefighters retire as millionaires because they follow these principles. The principles work regardless of your starting point. The question is, will you commit to them? Will you apply them consistently for decades? Will you resist the temptation to chase what's hot? Will you be patient enough to let compounding work? At BlackRock, we've built $11 trillion in assets by following these principles. We focus on ownership. We think long-term. We manage risk obsessively. We build lasting relationships. We've cultivated a reputation for reliability and expertise. And you can do the same with your personal wealth. Start now, build your ownership position, commit to a long time horizon, master risk management, focus on what lasts. Cultivate your reputation and network. Do this consistently for 20, 30, 40 years. And you'll build real wealth, maybe not $11 trillion, but wealth that gives you security, freedom, and the ability to live life on your terms. That's what these 5 lessons can do for you. That's what I've learned from working with the richest investors in the world. Now go apply them. Build lasting wealth, and maybe one day you'll be teaching these lessons to the next generation.